Taxes will be the largest cost you'll ever have in your lifetime, taking a significant chunk out of your income every single year. Therefore, by knowing these simple and effective methods to reduce your taxes that really should have been taught to us in school, this can help you to save much more money, so you can have much more money to invest or spend on the other things you enjoy in life. So today, I'll be showing you methods you can start implementing right now to start reducing your taxes and save thousands and thousands of dollars. But before we get started, hi, my name is Josh, I'm an accountant. I like talking about investing, finance, and showing my finance journey over time. Sounds like something you're interested in? Would be greatly appreciated if you could hit that subscribe button. But first, to learn how to reduce your taxes, you first must have a decent understanding of how taxes actually work in the first place, because many people actually have it wrong. A common misconception around taxes that I hear many people say is, I don't want a pay rise because that way I'll move into the next tax bracket, meaning I'll be paying more money in taxes. For example, say you're from the UK and you earn £50,000 a year and you get a pay rise to £55,000 a year. Now you've moved up a tax bracket from 20% to 40%, as you're now earning over £50,271 a year. Now I hear a lot of people saying, now won't I be earning less money because I only got a £5,000 pay rise and now I'm paying 40% tax rather than 20% tax? Well, luckily that's not exactly the case, because in most countries they have a progressive tax system, meaning you only pay tax on what you earn over the next tax bracket. And just to name a few countries for examples, we have America, China, England, New Zealand, which all have progressive tax systems. So let's go back to the UK example, where you got a pay rise to £55,000. You will only be paying 40% tax on the amount that is over £50,271 a year, meaning only £4,729 would be taxed at 40% and not the full £55,000. Now the first way to reduce your taxes is by putting your money in an investment account that is tax-free, meaning you can put your investments in these accounts and earn dividends and capital gain tax over time. And when it comes to retirement, you often don't have to pay any tax when you sell, because it's probably very likely you own some sort of investment such as stocks, crypto, or rental property that if you were to sell would be taxed at one of the highest rates. So why not try and put it in a tax-free account? Now most countries will probably have some sort of tax-free investment account, such as the US has the Roth IRA and the UK has the ISA. Now of course, depending on where you're from, each tax-free investment account is going to have different legal rules around them. However, majority of them allow you to put almost any sort of investment in them. Now basically what this means is when you input your investments into one of these accounts, when you earn dividends and capital gains over your lifetime, when it comes to retirement and you sell, you won't have to pay any tax on these. However, if you weren't to invest in a tax-free account such as a Roth IRA, when it comes to retirement, all your dividends and capital gains would be taxed at a very high rate. For example, let's say you're from the US and over your lifetime when it's come to retirement, you've made $1 million in capital gains. However, you did not have this capital gains in a Roth IRA. Now let's say you're also married and filing jointly and have a combined income between $83,351 and $517,200. Now on $1 million capital gains, that would mean you're paying 15% tax on that, meaning $150,000 would go to tax and you would only be left with $850,000. However, if this investment that made you a capital gain of $1 million was in a Roth IRA, you wouldn't have to pay any tax on it when it came to retirement and you wanted to sell, meaning you'd have the full $1 million that goes into your account. So getting a tax-free investment account can make a huge difference in the amount of tax you don't have to pay. So the quicker you open one, the more you can save. Now the second way you can lower your taxes if you have another income that is like a side hustle. Now the amount of people I see who have a side hustle or a small business that's bringing in income for them on the side of their main job that haven't set up this business in a way that can save them tax is astonishing. Because if you have a side hustle or a small business, you're going to have expenses that could be used to help pay less tax. For example, let's say your side hustle makes you $10,000 a year and the expenses you incur during the year is around $4,000, meaning your taxable income would be $6,000, meaning you'd only pay tax on the $6,000 rather than the $10,000 you earned in revenue. Now all you have to do is keep a record of the expenses you incur in your business during the year to decrease your taxable income. Now this basically means means you have to keep invoices, bills, receipts that relate to your business or side hustle. Basically just to prove that these expenses incurred when you were making income from your side hustle. Now let's say for the same example we just talked about above, for the $4,000 expenses, if you didn't have any record of them happening, you would have to pay tax on the $10,000 in revenue. Now you might be thinking, how does this relate to my side income though? Well, let's say you're selling plants. If you have to buy dirt to plant the plants, that's an expense. Now let's say you had a side income of mowing people's lawn on the weekend, the maintenance and petrol for the lawnmower would be considered an expense. I'll even go as far as saying if you owned a dog walking business, the leads, the poop bags, the treats you buy, could all be written off as expenses. Now all these expenses can then be deducted off the revenue earned, so you're paying less tax. Because if you're in the business with an intention to make profit or selling the same thing over and over, you're going to have to pay tax, so you might as well pay less tax by deducting those expenses. Now extra tip, if you're about to start a side hustle or a small business, make sure you make the first sale first before going and buying all your inventory and materials, because that way it will be tax deductible. But if you were to buy all your inventory and materials before you made the first sale on your business, that would mean all the inventory and materials you just bought would not be tax deductible. Now another way you can easily lower the taxes you have to pay is by opening a pension fund. Now almost every country will have some sort of pension fund where every pay period a tiny proportion of your income will be deducted and put in a pension fund. Now often as an added bonus, your employer will often add in the same percentage as what you put in your pension fund. Now the money that is deducted from your pay to go in your pension fund is your pre-taxed income. Basically meaning the money going into your pension fund is tax-free. Now pretty much meaning this is an account that is completely tax-free even when you take out the money. Now often you can only touch the money in your pension fund if you retire or if you're going to buy a house. However, these rules for pension funds will change depending on what country you're from. Now, another added bonus of a pension fund is you often earn compound interest in it, which is also tax-free. Now, just a little added bonus for you good Samaritans out there, another way you can actually pay less tax is by donations. Now, often in most countries, if you make a donation to a charity or a church, you can take those tax receipts and send it to your government and get a tax return, which is basically where the government will send money back into your account. Now you won't be making more money, but you could be paying less tax while donating to a good cause and helping other people. For example, if you're from America and you make a donation to a charity, you can often claim back around 50% of what you donated, or if you're from New Zealand, for every dollar you donate, you can usually claim back 33.33 cents. Now if you were to make a $1,000 donation to a charity in New Zealand, you could claim back a tax credit from the government of around $333. So now, if you can start implementing some of these methods to reduce your tax right now, you can end up paying way less tax. Because as I said at the start of the video, tax is the largest expense you'll ever incur in your life, even bigger than your mortgage. Anyway, thanks for watching. Want to learn how to save over $10,000 a year from stopping these bad spending money habits that I guarantee you have at least some of? Check out this video right here.